sadly, we've come at the tail end of the glorious bull market in equities, where post 1990 you got 35 years of one-way bull market. Interest rates kept going down in the world, and equities and equity multiples just kept going up. At the tail end of that, we have realized equities is a way to wealth creation, and our young population is only now coming in. When the paradigm changes, you can't invest for the long term when there's a change in the rules of the game. So it is that sort of period I feel where it should have happened already in 2008-9 if the world had woken up. A, don't be scared to create cash. B, think differently from what got you these returns in the last 4 years. The returns in the next 4 or 5 will be from somewhere else entirely. And my bet would be it will be.
Once again, ladies and gentlemen, a very warm welcome to the very first edition of Groww Legends. And like I've been saying, this is the conversation that we have been waiting for. He, of course, is the director at Enam Holdings Private Limited. He began his journey as CEO of Enam Securities, which later merged with Axis Bank to form Axis Capital, a firm that helped raise nearly 25% of all equity capital in the Indian markets. He went on to co fund the multi billion dollar Enam AMC and also served as chairman of TPG Growth India, advising global funds along the way. Now, beyond markets, he has served on the boards of leading companies. He's contributed to SEBI committees, and he is on the governing board of Flame University as well. He is also a trained vocalist, and he is a Vipassana practitioner. He is equally passionate about philosophy, history, and investing. And once again, it's our true privilege to have him with us. Can we have a round of applause, please?
Thank you.
Like I was saying, my first question is going to be a little bit filmy. We've seen highs and lows starting September 2024. There are 2 points of view. There is one pool of experts who say, ye kya hua, ye kaise hua, kyun hua, right? And then there is another side which says, ye to hona hi tha, right? So I think I want to understand first that which song is appealing to you more, or is there a third one?
Good, great question, Radhika. So thank you everyone for being here. But uh, I'm in the camp of ye to hona hi tha.
Aha,
Uh,
okay.
if you want, I'll give you a little long answer, which will give a
Please.
framework to
Yeah.
think about it. That post the Second World War, when the world made a new architecture, the US took control of the world and they created a world where they set up rules by which the world operated. So, how you did trade, how you did immigration, how you remitted money from place A to place B was all set by them. And then by the time you came to the 70s, you realized that this system on currency front is not working because they used to be pegged to the gold standard. And that was found to be restrictive because people were consuming more than they could afford. And therefore, there was a debt bubble. So they depegged from gold standard and went that the peg will be to US dollar. So from then, US dollar became gold. And every decade, they caused a bubble to happen in some market or the other. Some people are very young here, some maybe a little more elderly will remember. So in the 70s, you had the bull market in the US Nifty 50. So Polaroid and Xerox and Disney and so on. That bull market died, and the next decade went to hard assets, where the peak was made in oil, gold, silver. Then that bull market died. The next decade, it went to the then emerging markets, which was then Japan and Taiwan. And those markets went up 10 to 12 times in that decade. As that bull market died, and we came at the tail end of that in 1990, 1991, when those markets were dying, Harshal Mehta was doing the Indian scam. But by then, the bull market had again shifted. And by 90s, you got the top of the technology sector in NASDAQ. Then that bull market dies, and in 2000 to 2010, you got the back to the emerging market, the so-called BRICS, Brazil, Russia, India, China, and you got the whole bull story there. And as expected, that bull market died, and you went 2010 to 2020, went back to technology in the US. And then COVID hit. Normally, you would have expected the whole decade to come back to emerging markets and hard assets. But because they printed unprecedented amount of money, the bull market continued in US, and you created this what I call the AI bubble and so on, where Magnificent Seven have taken that market and just held it, whereas the rest of the 493 stocks in the US haven't performed, and US became 70% of the world. So in any case, that market was due for a blow up. The other thing which happened in this period of so much money printing is US numbers have started looking terrible, where the current account deficit, the fiscal deficit looks even worse than India at its worst time. So when I say ye to hona hi tha, any rational government would have come and I said I need to fix this current account. The measures they are taking are through tariff to either drop domestic demand or make the producers bear part of the pain. On the fiscal side, what they're doing with Elon Musk and Doge is to cut government spending and get the fisc under control. And the third thing which they're doing is we can't keep financing the world, paying for the war in Ukraine, war in Israel, getting immigration inside. So what they are trying to do is inevitable. The way they are doing it is absolutely absurd. So that's where the uncertainty now arises from. So long way to get to the point of what you were asking.
You actually already given us a great summary of how global markets and with that, the Indian markets linked to that have evolved since the First World War. But, you did refer to the tariffs, and that is on everybody's mind right now, right? There was a view that Indian markets are resilient, and, some of the corrections we are seeing, this is factored in. Do you think that is changing? Do you think we will see deeper cuts in the Indian markets because of what's happening on
So
the tariff
sadly,
front?
yes. Short answer is yes. Uh, the Indian market from last September sold off on the back of high valuations, and by then China had come back. And like I said, the smart money was already moving to emerging markets and hard assets. So you saw the rise of China, you saw the rise of gold, silver, other precious metals, and so on is already happening. There's a bull market which has started there, and these developments are only going to strengthen that. We came off an extremely high valuation on mid and small caps in particular. Large caps still looked okay, and like we've spoken earlier as well that the financials looked okay, and you had reasonable valuation. But like you get an excess on the way up, in a period like this, you can get an excess on the way down as well, because remember, foreigners still own 15% of the market, and it's not a mainline market. I mean, for us, 4 trillion market cap is a large number, but the world is at $110 trillion market cap, so we are like 3.5% of the world. In that, if they own 15% of India, it's like for someone in Bombay selling his stock in Sri Lanka and Bangladesh. It doesn't change his overall portfolio in his home market. So there is a possibility, and I don't know how people will behave. And the FIs are not just one group; they are a discrete bunch of people as well. But I don't think you should rule out that FI selling can continue. Not for Indian reasons, because India has been doing the right things in the last few months economically, both from RBI as well as from government. But the way the flows are in the world, we could be still in a patch of bother. Because he's created a lot of uncertainty and it's a resetting of the rules of the game entirely.
Yes.
So in that period, you don't really want to make long-term commitments. Your risk appetite goes down, you come closer to home base. If you think as an industrialist also today, even though I see this tariff happening and India's tariffs are better than Bangladesh and China and Vietnam, am I likely to make a bet to put a factory today knowing that Trump will be gone in 4 years? And same way, if an investor, it's a pension fund or a university endowment, how do they take a bet for 4 years, 5 years that we don't know how the lay of the land will be? So in a period of uncertainty, you typically get what you call higher risk premiums, which means lower P multiples. I mean, short answer is
Okay. So, again, so many points that I could take off on, but what does this really mean for the global economy and direct impact on the Indian investor, many of whom are joining us today?
so global economy has lived beyond its mean. I've been, I think, talking for 10 years that there will be a currency realignment in the world. Just take the simplest example, take United Kingdom. It was known for oil from North Sea, which is over. It was known for manufacturing, which now Tata Group is the largest employer in UK. So there's no manufacturing left. They were known for retail. When you went to London, you went to Marks and Spencer and Selfridges, which is now all deserted. They were known for financial sector, where they've made all these so-called non-doms leave the UK. So UK is basically now London real estate versus the rest of the country. And London real estate was the Saudis, the Russians, and the Indians who were buying real estate. Then they stopped the Russians from coming, and now they don't want the Saudis and the Indians either. And the pound stands at whatever 100, 110. There's no way on earth it can stay there. Current account deficit, balance of payments, fiscal deficit, big mess. So in this decade, you may see pound at 50 to the rupee. Now, are we ready for something like that? So I said those kinds of paradigm shifts, and you look, boggled when I say it, but you go back across decades, it's happened to countries. Those who lived through, say, the 1998 Asian crisis, currencies stumbled and went down by 50%. And this is what Trump is also trying to do. He wants a realignment of currency with China as well. Because China is sitting on $1 trillion surplus on trade. How can the Chinese yuan be pegged to the dollar? Pretty much. Since 2006, the yuan has stayed pegged to the dollar, and Indian rupee has collapsed, and still our exports haven't gone up. So it's not to do with our currency or our competitiveness. We just don't have the product or the quality which the world wants. So a lot of changes are going to come, is all I'm saying.
So of course, Trump has also
Yeah.
spoken about and against the BRICS nations developing their own currency, which was on the cards. But is the US heading for a recession?
They're planning for it. He said that in his interview as well, that there is a transition period. And if you have consumed in excess of what your income levels are, there's a stunning statistic that 65% of Americans live on a paycheck week to week. 60% of Americans receive some form of check from the government. So it outwardly looks like a rich country, but internally they have had no change in real income since the 1980s. 12% of Americans own 90% of the stock market. That is the measure of wealth. But the rest of America is not in good shape. Like a lot of people here, you would have had relatives. You remember when they would visit us in the 80s and 90s? You're too young for that, but we would look at as if some alien has come from outer space and they are so rich and we are so poor. And now when they visit us, it looks exactly the opposite. They are seeing you driving around in nice cars, nice homes. You have staff over there, and they are like, "हम तो कपड़े धोते हैं, हम गाड़ी
And
साफ
they
करते हैं." Like,
envy
what are
our
we doing?
quick commerce as
So
well. Yeah.
it's a transition, and I made the point about UK to say this mirrors the rest of the world. I had friends I went to college with who were Japanese. There's someone who's head of a very major bank, and he commutes to work in the context of going Nariman Point to Goregaon in Japan. Their standard of living in Japan has stagnated for 35 years. Debt levels are very high, but the currencies haven't reflected that as yet because the rules was set by the G7. And what China, Russia, Saudi, and actually even India, which without seeing, were trying to do was to get this realignment. We can't give a currency license to China. Otherwise, the BRICS currency was a reality. But what China has already done is created a substitute for SWIFT when you do your interbank transfers. They've already signed up the whole of ASEAN. Russia and Saudi and the UAE are all on board. So if US switches off today, there's trillions of dollars of money flowing through the Chinese system, and they work faster. You can do a money remittance using the Chinese system in basically seconds, whereas my SWIFT transfer through my bank takes 3 days. So this architecture is being changed, and whether they realize or not, America is playing into the hands of China now, and everything is made in China. So if they switch off and they put tariffs, even if they want to put a factory, it's going to take 3 4 years for that factory to come up in US. In the meantime, what do they do?
Yes.
So it's a period of great change, and I don't think we should approach investing as if it is the same as the last 30 years. It's not, because the US is trying to change. So we can't assume that everything will be the way it was in the last 30 35 years.
So we are also seeing the China plus one, right? Where,
So, I mean, China plus one in theory was there for the last 10 years,
but now more
and it
so
bypassed us and it went to Vietnam. Bangladesh
Bangladesh.
exports more garments and textiles than India.
Missed opportunity, you would say?
Miss absolutely, because of our internal problems, that we don't have the last mile connectivity to the port. The labor laws are not conducive. The way your factory inspection happens, like the average Indian industrialist deserves a Padma Shri for what he deals with. It's really a hostile environment to operate in. Uh, and say in garment factory, you have 3 shifts in Bangladesh. Here, you're not allowed.
Yeah.
So there are things like that which we are causing self goals. And with this coming of AI and robotics and all in the next 10 years, I really wonder how we lift people up. So we'll see. We'll talk about it.
Yeah, I do want to talk about the role of AI in the future, but I think one question on everybody's mind here is that with the current tariff scenario, so much volatility, what should an existing portfolio be going through? What are the changes one should be making?
So number one, in period of uncertainty, when you say risk premium goes up, it means multiples should be lower. So if you're sitting on these 50, 60p stocks, I think stop dreaming. Just you've made your money, take it, and once sit on the side. There's no harm in sitting on cash. I've done it thrice at least in my career. Just before the Harshad Mehta scam, we were 100% out of the market. 2001, when Infosys gave their profit warning, you know this is going to tumble, it's going to take the market. A bull market starts always somewhere else. I'll cover that also. And then 2007, in this madness of subprime and Reliance Power IPO, again completely out of the market. Uh, so, but every bull market gives you a rise in some other asset, which is what the example I gave you from the
Yeah.
70s, that one thing died and something else comes up. The odds are this bull market this time will be in hard assets and emerging markets. And emerging markets centered around the world, which unfortunately China has created, where they are impregnated inside Europe, they are inside ASEAN, they are inside Africa. Unfortunately, we are not as friendly. But you see the geopolitical change which has already happened with Xi Jinping saying that elephant and dragon should dance together. Because he needs a new market and he needs a new source also from which maybe he can export out. So if these games are played smartly, America, end of the day, it is 25% of the market of the world, but it is only 25% of the world. So it's not the end of the world if they start acting funny, and they've alienated everybody. So, uh, A, don't be scared to create cash. B, think differently from what got you these, returns in the last 4 years. The returns in the next 4, 5 will be from somewhere else entirely. And my bet would be it will be a lot of hard assets because it's hard to put up factories, it's hard to get material out from the ground. And with US causing this kind of inflation due to tariffs, prices of things are going to go up a lot more than people realize. And when currencies change, you'll be surprised what happens.
Do we need to reframe what risk means in the current market?
So sadly, we've come at the tail end of the glorious bull market in equities, where post 1990 you got 35 years of one-way bull market. Interest rates kept going down in the world, and equities and equity multiples just kept going up. At the tail end of that, we have realized equities is a way to wealth creation, and our young population is only now coming in. But when the paradigm changes, you can't invest for the long term. When how do I say there's a change in the rules of the game. So it is that sort of period I feel where it should have happened already in 2008-9 if the world had woken up. If you again go back, when America started printing in 2008, Europeans followed, everyone else followed, India followed, but China kept its currency steady against the dollar. And you see what China broke out in the next 10 years and created all the capacities, all the technology, and went up the value chain. We used to say back then that China can't compete in software with India, for example. But our largest software company will be Infosys will be like less than 100 billion. TCS will be like 150, 160. Alibaba, Tencent, Baidu were 500, 600, 700 billion dollar companies. So the scale at which they've created and innovated was unprecedented, and they kept the yuan pegged to the dollar more or less. So the country became rich. We went the other way. We gave all the money printing to the Narega program and missed opportunity to get our manufacturing and everything sorted. So when the last government came in 2014, we thought a lot of this will change. Some of them have changed, but still we've been held back by our own sort of shackles. So let's see.
Okay. You were speaking about FIIs earlier, and after COVID, in fact, actually, let me ask the question. After COVID, we saw a lot of young investors come into the markets. You spoke about that. They hadn't seen the markets go down the way they did. Do you think there needs to be a reframing of what profitability looks like?
Yeah, I mean, a lot of me and my colleagues, we've said this repeatedly that ultimately you make money which is equal to the profit of the company. You can't be separated for very long. The underlying profit and the return profile of Indian companies is around 15% on equity. And the debt return, like if you were in a bank, you would make 7%. So when you pay that extra risk premium to make that 15, that's the multiple, which is why we pay a little bit more for that extra growth. Otherwise, you would pay the opposite of a interest multiple. Let me do it in a simple way. If you put 100 rupees in the bank and you get say a 8% fixed deposit return, 100 divided by 8 gives you 12.5. That's your base P multiple. But now there's no growth. So if someone can give you 20 rupees for that 100, what is the multiple you would pay? It can't be the same as a 8% return. So you'll start paying a higher P multiple for it. And that's really the underlying basis. So when you're paying 50, 60, 70 times for so many companies, you're playing with fire. It's like you bought an apartment and then you're renting it out at 2%, thinking that the apartment price is going to go up. It's not going to go up. I gave this example last year, I think, in around Diwali time. The most popular stock last year, for example, was Zomato. A great company, doing great work, everything great. But I gave the example in 2001, Infosys, which was then the greatest company and still a great company, had a market cap already at that time, I think, of $45 billion. And 25 years have passed and it is now at $95 billion. So it's become double, but over 25 years. The index goes up typically at this 15%, you'll go double in 5 years, so 4 times in 10 years. So in 20 years, you should have been 16 times as opposed to 2 times. And this is, of course, in dollar terms. So because rupee fell, you may feel I did a little better and worse. So using the same math for Zomato, which was then 300 rupees, I say if you want to make even 4 times on Zomato, it has to become 120 billion market cap. And on that, at that time, it will be a fairly mature company like Infosys. Then was a 50p and now it's a 20p. Let's say we give benefit of the doubt and we give a 30p to Zomato 10 years later even, which is generous. So you would have taken a 120 billion potential market cap for what you want to just meet the index. Divide 120 by 30 and you'll get a $4 billion PAT. And for context, today TCS PAT is $6 billion. So it's not that that number is going to come. So you're playing with fire. It's a great company. Everything is fine, but you're paying a wrong price.
But valuations are tricky.
Valuation
right?
is
tricky.
That's the crux of the matter. That what are you paying? And like I said, over time, if the business is going to make a 15% return and you're paying north of 20 multiple, you really have to have a view that this business is going to keep growing and no trouble like Trump, no trouble like war, no trouble like COVID, nothing has to come. Perfect execution, which never happens in India.
But what happens is that, there are certain narratives that are built, right? And then one tends to follow those narratives, right? So, what is your advice to investors? How do you sort of behave rationally when the narrative is somewhat irrational around valuation?
You said in the beginning, I do Vipassana. One of the reasons is you stay equanimous, that this too shall pass. So, a bull market is not permanent, a bear market is not permanent, Trump's tariffs are not permanent, Trump is not permanent. There's no reason to despair. It will pass. And what happens in both times, you get excesses. And if you are even minded through this, like I promised, I'll tell you, previous cycle we were selling in the Infosys period when we sold the tech stocks. For example, PSUs at that time were selling for dime a dozen. I remember we were buying BL for 60 rupees and there was 80 rupees cash in the books in the balance sheet. So you got opportunity like that. Concord, BL, SBI, Grasim, they all eventually went up 15, 20 times in the bull market which came 2002 to 2008 was the most spectacular bull market. This time it's come in small caps, but now when people are finding that they want to sell in some size, if I want to sell 10 crores worth of a small cap, I can't do it. So it was a notional value in my portfolio, it's not a realizable value. Unless it transitions and become a large company. Like a Zomato may have started small and it's become a large cap. But if you're holding something else, I don't know where you'll end up and how you'll get your exit. And are you comfortable holding it for the next 5 or 10 years?
Okay. So, there has been talk about India becoming a $30 trillion economy, say by 2050. But are there any blind spots that we should be watching out for in the growth of the
country? I mean, look, it's
country?
not a given. I mean, 100 years ago, Argentina was the richest country in the world and then they blew the opportunity. So it's not a given. We have the odds. Our people are definitely smart. They are gifted. If we can go out in the world and the top talent in Silicon Valley is all Indian, it tells you that it's not the problem with the Indians, it's the problem with the way India is running itself. So even when this China plus one happens, why is the whole trade gone to Bangladesh, Vietnam, Mexico? It's a attitude problem over here. And in that, the entrepreneurs who come out, who can navigate through this, they become multi-billionaires. They deserve to, because that's the degree of difficulty and pain they're fighting with. When I say they all deserve Padma Shris, you're dealing with some inspector can randomly turn up, someone can stop your shipment, someone is yelling, some tariff is changing overnight, some tax laws are changing. You're dealing with that kind of uncertainty, which is why in India, unlike what Buffett says abroad, he says buy the business because eventually a monkey will run it. In India, you have to buy, like what Utpal has defined very well, you buy the gorilla over here because he will redefine the jungle. And in those businesses where people have become sector leaders, those valuations are very hard for others to come and compete. Even take the current very live example in this market. Asian Paints has been the leader in paints, and it's taken the combined onslaught of Birla and Jindal to come and say we want to move these people out. The market has priced it, but it's not yet happened in the marketplace. Then they announced, you saw money being made in, for example, wire and cables with Polycab and KE and Havels and so on. And again, people look at a market opportunity and say, we want to launch over here. Market will always price the worst because you were sitting on a 60, 70p, you got scared. If it was a 15p, we'll say, dekh lenge, aane do. We'll fight in the market.
Do you feel that value investing has changed?
You're still asking me this question? You saw what happened. Who's looking the smartest in the world? Warren Buffett.
Yeah.
Sitting on $330 billion of cash. What does it tell you? For the last 6 months, the man is signaling to you something is wrong. Get out. Keep cash. He can't say it. I can't come on TV and say, get out. I'm on the Diwali. We are all on TV and telling you valuations are wrong. I'm giving you a Zomato example. I'm giving you Infosys example. Or kya bolega koi? It's your money. Please do what you want with it. But your money is hard earned.
You're being as direct as it gets.
No, but on a public platform, you cannot come and be preaching bad news. Nobody likes a bear over here. No? Everyone wants to hear Rakesh only. Like everything is bullish. Everything is great. Definitely, India will become a large economy. All odds are in our favor. But there are risks. We are not creating jobs. AI is coming. Robotics is coming. We have to go up the value chain. It's not a given that will happen. But the flip is the entrepreneurs are great. The youngsters who are coming up, despite what the minister had to say, it's not that everyone's only going to do home delivery. Yeah. There are people doing drones, they're doing space, there is stuff coming, and money is available, and it sometimes takes time to show. Someone put out a nice tweet also. He said before Elon Musk made Tesla, he made PayPal. So he didn't directly come to SpaceX. He also had to go through a process, which we will also do. So I'm still very hopeful on our country. And like I said, by and large, our entrepreneurs, because we deal with so much mess, we've defeated all the multinationals over the years. If you take the FMCG businesses, we used to say no one can beat Lever, and then you saw Godrej and Dabur and Marico, and all have come and done well. Haldiram gets $10 billion valuation. So who cares about Lay's? We like Haldiram in India, and that'll do well. Same thing in pharma. The largest pharma company today is Sun Pharma or Cipla or Lupin or whoever. Same thing happened in banking. All the Bankams and the Citibanks are all gone, and it's HDFC and ICICI. So sector after sector, entrepreneurs have shown they know how to run it. We know how to produce a return. And the degree of difficulty in a country is the margin you make. Because we're a difficult country, we make this kind of return. We've been a great market. There's no reason why if you do 4 times in 10 years, as an average for the index, you take 20 years more from here when they say Viksit Bharat, 20 times from here, you can imagine 4 trillion market cap of today going up 20 times is 80 trillion. I didn't even say that. I said we'll get to say a 25, 30 trillion GDP and we'll be at 1.5 times. So 50 trillion market cap means you still have 90% of wealth of India lies ahead of it. It's not in the rear view. But I can't say that about Japan. I can't say that about Europe. I can't actually even say that about China now. While they're doing the most innovation, but the population is now declining over there.
And the returns on investment in their markets have been fairly...
No, so they think about it as a nationalistic goal. So when we visit companies there, you find there'll be 110,000 people in the R&D team. You try stuff and let's see what comes out. The gross margins they make in China, for example, if you take BYD, which now leads the world, you would expect the gross margins to be much higher. Then you're very surprised when you go in. And then you see the conversion from gross margin down to profit level, EBITDA or PBT, is even lower because they have filled up people to do new R&D. So that 7-8% R&D cost, which we used to see in the US earlier in pharma and tech, is now being seen in China, and they're not so focused on producing a return, because for them it's about employment generation and about how do you say, making their country USA proof. So it's not the greatest equity market, but some of the companies out there are just outstanding.
Yeah. So, I want to go back to the last answer you gave. And, there is a view that in India, a lot of investors actually put in a lot of effort, research into the buy side, right? What they're going to buy. Why are we not able to take the right sell decisions? And, there was a clip playing earlier of yours where you had commented that, FOMO nahi hona chahiye, greed nahi honi chahiye. So I just want to understand, if you can educate us on that front, when do we take those calls?
So there are two things I usually say to that. Number one is that we are buying stocks bottom up. And you have to buy, like I always say, think of a stock, will it be a 5 PE in 5 years? That makes you focus your mind. Like my son is now investing actively. So I say, if you have to think it's 5 PE in 5 years, that means you need to have a view on what the earnings will be. And you need to have a view on how the perception of this business will be, because that's our advantage against a fund manager who's playing for every quarter. Because the narrative of today will be very different in 5 years. So is that going to be sustainable? And why I said 5P, because if I get my bet wrong, maybe it'll go to a 15 multiple, which is 3 times. If it's a, because we not buy stupid companies. So by and large, it'll be a good company. So you'll make a 15 multiple, and if you're lucky, you'll make a 25. Occasionally, you get markets like this or like 2001 where people go to 50, 60 multiples, and then you just keep riding till you see a crack in the market. So the first answer is really that buy so cheap, because that's the only thing that is in your control, the day you buy. And then next is the day you sell. Everything in between is based on what happens in Parliament, what happens in USA, what happens in China. Nothing is in your control. So if your buying is right, and second is you get signals from market cycles, which I'm a great student of, and I'll encourage people to read. Like Mark Faber had put out a beautiful cycle of emerging markets, which I learned when I was very young, and it just holds true till this day. Then the cycles I gave you about this alternating of financial assets to hard assets every decade has worked out magically across 50 years. So there are things like that, but eventually it becomes a valuation thing. That in your head, if you see if this stock falls 33%, am I going to be a buyer, or am I then waiting for it to come up 50% just to come back to this price? And it'll actually give you the answer. You're holding it in hope. That's why when it falls, you're clueless that now what do I do? Because the basis of your holding it was a momentum trade. And my mentor, Vallabhai's elder brother, Manibhai, taught me very well that when a stock crosses a fundamental threshold, one of my worst sell in life, which I've also spoken about, was Z, which I made 10x, 12x, and then I sold it, and in 3 months, it went up 20 times. In 3 months in Ketan Parekh era. Because either fundamentally the stock doesn't deserve to be worth more than this. So you feel like a genius if you made 10, 12 times in 2 years. But the market was in complete madness, and there was operator or whatever. And he said, when you're selling it fundamentally, now sell it to your technical portfolio and watch what is the market telling you. And if you see what he called a rising top, rising bottom pattern, you keep riding it. And when that turns and it breaks, then just sell it. Then don't try to justify the fundamentals. Then just sell it, because you'll still get an average which is better than what it was if you had just sold it fundamentally. So sometimes it works, sometimes it doesn't. But that's a scar I carry till my day. I don't know if it was a good thing that I made 10x or it was a terrible thing I lost the. Just to give in context, if you made, if you put, let's just say 10 lakhs and it becomes 1 crore, in 3 months it would have become 20 crores. Just to give a context.
That is a quandary we are all in, right? All the time. But I do want to talk to you about the many, many market cycles that you've seen, and you've referred to, some of those. What are some of the traits, if I may ask, of the successful investors in those cycles? What can we learn from those investors?
So a great question. So two, three things. I've always said this, that a good investor is always only making a asymmetrical bet. कि like निमिष भाई used to say इसमें खोने का कुछ नहीं और कितना कमाओगे you can't imagine, but that means upside should be unlimited, downside you cannot lose money. Like Buffett's rule number one, don't lose money. Rule number two, don't forget rule number one, because only buying right at a price which is a distress price is really what a value investor's job is. Because like I said, after that day, nothing is in your control. So number one is you bought at odds which are very, very skewed in your favor. Number two, when they get odds like that, we don't go around buying 50 stocks and 60 stocks. We 2% allocation there. Position sizing is you really load up on that then. But that's why your study of that company and the conviction on that has to be large. And three, then they have the patience to digest profits. Like I gave you this Manik by example, that I would be at 10 times now I'm nervous because I may not feel deserving of that money or I don't know how to value it. But they also are students of the market. Let it run. Like in our markets, the most famous example has been of legendary Rakesh's buy in Titan. Now imagine if he had bought Titan and he had bought 2%, as opposed to he bought 6% of the whole company. And then to digest that gain when it keeps going up, 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 and you live through 2008 crash, and you could say this is my best position and I can get out, but you can see what will happen to consumption and India and Tata. And it's not an absurd valuation. Actually, you go back and look, it never really went to absurd then. It went absurd later. To digest that profit and sit on it, that's the stuff of legends.
So AI is something you refer to. How is it changing investing in India as we speak?
I think AI will change. It's like an industrial revolution moment. Pre the industrial age, the artisans made goods and they extracted a premium from the aristocracy. Then the machines came and the artisans all moved out and became factory laborers. I think that's the AI moment for the average middle layer employee is that. And it worries us a lot about what happens to Indian IT sector, Indian GCCs, which are today flavor of the year. The entire middle layer, for example, we have a lot of investments in banks, which is the first beneficiary of AI. Because who is going to win in AI? If you have structured data, first of all, you need data on which the AI can then give you actions or decisions, or you can use your agents. Once I have data, for example, your credit history or your transaction history, and so I know how you behave, your life cycle, everything you become in a cohort. Do you really think you need 20,000 officers then to be sitting and doing that analysis? So the tech productivity gains is mind-boggling. It happened for in the industry we were in fact Groww. If you think when internet came, would you have imagined that there would be a company called Groww or Zerodha, which would be the beneficiary of that? Like we started distributing research to clients all over the world at a fraction of the cost. We became accessible to clients all over the world, which is why when you said Enam could do 25% of all money raised, we were competing with Goldman Sachs and Merrill Lynch and Morgan Stanley and beating them because we know this market. The client knows we know the market, and they're going to trade with us. And the same thing's going to happen in financial services, in capital market businesses. Why would you put money in a Fidelity fund when you can get HDFC or ICICI, which knows the market much better over here? And we can use that data. And if you can use that data along with what I still think the individual power of intuition and empathy cannot happen with data. Like when I said the next cycle, the AI will be trained to know that this cycle is going to come somewhere. But where it's going to come, whether it's intuition or whether it's that networking knowledge, because the computer doesn't go out and talk to the entrepreneur. Eventually, it's still the human being going out and. So I think those things will still give you the edge. And people who use it smartly will become disproportionately large. And there are people in India already doing that work.
So, every bull run has a theme, right? We've seen it in the past. So, I believe, would be one of the big themes.
AI is last 5 years theme.
Okay, so what's next then? Which was my question. What's
see,
the next
like
big
internet
theme?
was, we knew internet will be big in 2001, but the Nasdaq did not come back till 2012. Infosys peaked in 2001, it didn't come back till 2012 to that same price. So, like what you've seen with Nvidia, we saw with Cisco. In 2001, Cisco was the one building the internet, and today, do you discuss Cisco is like some yesterday's company. So, the beneficiaries of AI are the people who will use the AI, And like the Microsoft CEO came out and said, we don't know why we spent $600 billion on capex on AI. We don't know the use case. You can't be building images on Twitter and doing queries to improve your Google search, using Chat GPT. So the use cases will come. They will become deeply embedded inside companies. I still think structured data exists in financial services. It exists in healthcare. So we will be beneficiaries of that beyond what people can't imagine. But before that boom happens, the next 5, 10 years, like I said, will belong to hard assets. Because when the world gets so disrupted and goods cannot move freely from country to country, the assets then become stranded, and the assets which are then in your home country are more valuable. Like take the example today, if we did not have, you know, safeguard duties on steel, China makes 1 billion tons of steel. They would have dumped everything into India, and Indian steel industry would be finished. Indian government sees that, they put a safeguard duty, and you see a bull market in JSW and Tata Steel. If these rules were not there, the steel industry would be finished in India. And not just that, industry after industry, we would not have had an auto industry, we wouldn't have had a materials industry, maybe the cement industry also. There's so much excess capacity in China and Indonesia. So these inefficiencies eventually give a rise to profit opportunities for people. So to put up a new factory now, if everyone wants factories and strategic autonomy in their own countries, like we want to make our own planes and our own armaments, our own infrastructure has to be made, our own manufacturing whole setup has to get lifted up, semiconductors we still have to do. So the opportunities are there still in India to make that level of money.
So I think my next question, I think you've hinted at the answer in a bit, but if we could filter it. So if you were building a long-term portfolio today to manage both deflationary and inflationary environments, what kind of asset
No,
allocation would we
Radhika, I
see?
correct you. You cannot manage a portfolio for both. Then it's the traditional 60-40 portfolio, that 40 is debt, 60 is equity. Kuch bhi hoga, to I don't know. That's a
I'm
person
safe.
who's not active. Safety means you don't make a return. Then you can say, I'll put it in a FD and I'm safe. You'll never lose, but you'll never make also. The environment today is clearly inflationary. When there's inflation, the price of goods go up. It has been inflationary. We have been stupid that we've allowed rupee to keep slipping, and the dollar strengthens after they are printing money and our currency is going down. You buy a cup of coffee in US, a $2 Starbucks coffee is now $8. That's the level of inflation in US. But the rupee has gone from 40 to 90. That means for us, the example I use here is we used to sell motorcycles for what, 40,000 rupees in 2006. And now if you get it for 1 lakh, you're thinking it's a cheap bike. And your purchasing power is finished. That's why we say, Array, but India has no market. India is not buying enough motorbikes. They're not buying enough cars. Well, we finished our market. And then we put high taxes on them. So we've shrunken it. So if these paradigms change, then the odds will change. So in an inflationary environment, you want to buy assets and products whose prices can go up and it doesn't give you a demand shock. That's how typically Buffett made his money in the pre-80s era. He was buying brands because they could do price increases and sell it. I don't think the FMCG brands are, the ones here. But say today you go and you fly on an airline. What were you paying for it 5 years ago? What are you paying for it today? Now airlines is typically the worst industry because a new guy comes, he can put the ticket price down. He wants capacity and he can kill you. But there are periods in time when the amount of money you make can be enormous over here. Like oil prices could be down, for example. That's the moment for airline stocks to be doing well. So I'm saying you don't think as an investor, we are not like an industrialist that I have to be sitting for 20. I have to have a view for 5 or 10 years. But when the market gives me that valuation, I can encash. The industrialist cannot get out. That's why what Vallabh told me in the beginning of my life was you can take the boom of various industries. Like we've compounded, we did 1 lakh times of our capital in 35 years. The market may be up from whatever 1,000 to 80, it's 80 times. You can do fantastic compounding over here because you can ride, different cycles.
I want to talk a little bit about philosophy, right? An area of interest for you. How important is having a mentor? You've had some very important mentors, you've spoken about them. How did they shape how you thought about investing?
So great question. Like one of the reasons we built Flame University was for that, to give you like a all-rounded view of the world. I don't think if you're an investor and you only know finance or accounts, you're going to do well. You must be at a stage able to even judge the entrepreneur, judge your team members, motivate them. You must have a knowledge of cycles and history and how things rhyme. They may not repeat, but they always rhyme. And what is the evolution of human society? Are we only here to make money and get rich, powerful, famous, or is there a bigger reason why we are here? What are those lessons? So if you can get all that together, this becomes like a game which you're playing because you're skillful at this game. The way a Sachin may be playing cricket, investor may be playing a game of investing is no longer about the zeros, but am I doing something? And in a way, you're contributing to the growth of the economy because you're shifting resources in favor of someone doing something good. If that framework you get now, it's also your receptivity that I may mentor someone and tell him the same thing Vallabh told me, but that guy may not receive it in that manner. Vallabh may well have told the same thing to 10 other kids. I was the kid who was lucky who received that message and I benefited from what he told me. But he told me a very nice thing. So I came from a family. My dad had a packaging company, and my whole training in life was to go and become an industrialist and become the biggest guy in packaging or whatever. And we were squeezed. Our customers were Hindustan Lever and Nestle in those days was called Food Specialties. They're like, Dad, we are going nowhere. These guys are going to squeeze, 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 and we'll never make money. He said, yeah, if you don't like it, we'll sell the business. Do what you enjoy. And that's when I met Vallabhai through Manibhai. And he said, son, you come from a business family. What are you basically doing? You're looking at an opportunity. Then you're building a management team to exploit that opportunity. And then you'll have ownership of the profit of that opportunity. But you don't easily have exit. Remember, this is 1990. You could not buy and sell companies so easily. But if you bring that same mindset of looking at opportunity, and then you choose management teams which come to you ready made, and you'll find the best management team, whereas you may not have been able to build that management team. And then how much share of that profit you want, you can buy that much of the company. But the trade off in your mind is now I don't have control, but I have exit. If this makes sense to you, come here. You can take the boom of every industry. Why are you limiting to one industry? And it made so much sense. I said, can I start this evening? And we had no terms. I just carried his bag for 20 years. We had no terms. All I said is, will I get that chair one day? He said, if you don't want this chair, don't come here. As opposed to if you went to an industrialist and were, a job seeker, he said, don't ever imagine looking for this job. ये तो मेरे बेटे को मिलेगा. So that's the difference of, like, when you're in a startup world, this is the new India which the kids don't want to go and do a job. They want to build something. Their parents, like we grew up where, our dad got their home or their car at the end of their life. Today, the kid comes out of college and he has a home and a car, whether with the parents or there's a mortgage available or whatever. So the ability to take risk and therefore make impact is so much greater. And therefore, when I spoke to my son, I said, till 30, you try and fail in something very big. Don't do chotu motu kam. Because that experience after 30, you'll be scared of my image and my ego and what will the world think of me. Till 30, nobody cares what you do. After that, you've got the experience, you know whether you've succeeded and you're playing big or not. And it worked for him as well. So just having, I think, framework is very useful. And reading.
Yes, actually, I was going to ask, if you have any recommendations for us.
I carry a list. Shall I read out? Or I
Please.
give you the most popular question. I'll give you actually a sampling. It may be overkill, so bear with me. I'm grateful you asked. That may be the only useful thing of the day.
I very much doubt that.
So, it's in no particular order. I wrote it in this way because that's how I think now at my age. So, the first lot is about actually scriptures. So, I've read all the Upanishads, the Gita, the Dhammapada. Eknath Ishwaran, actually, I enjoyed because he doesn't prescribe. Vinobaji's Gita I really enjoy because it was a extempore talk which he gave in jail while the freedom fighters were there. You could just feel electricity. Read our epics. There is something to learn about human dynamics in our epics. So that was category one. It may not be the most obvious thing you would have expected to hear. I read a lot of world history and on YouTube, but 3, 4 history books worth absorbing. One, of course, the great Sapiens of how mankind evolved. I read very early in life why the West rules for now. And now I read books on China and then Lee Kuan Yew, Third World to First. There's a fantastic book and also available on YouTube called Guns, Germs, and Steel on how the West went and took over the world. 90 people took over the whole of South America, the way 70,000 people took over India. And in that context, the great books of Dalrymple, The Anarchy, if you read how the East India Company took over India, or his new one, The Golden Road. Sanjeev Sanyal has a good set of books, Land of Seven Rivers, and so many more. Once you like it, you go ahead. I read Kautilya to understand what Amit Shah is up to, and Modi ji, and Machiavelli. But it's interesting. You get some perspective. For mental models, Farnham Street publishes good books on the different mental models, which I was very influenced early in life by Charlie Munger. That you must know the mental models and constructs of different fields, basics of physics, or basics of mathematics, or basics of accounting, psychology, and so on. Uh, and to keep abreast with what's coming up, I have a friendship and I read up a lot with Peter Diamandis, who does Singularity. So his first book was called Abundance. You read that as an introductory and then build from there. Psychology, again, it's a Charlie Munger recommendation, book by Robert Cialdini called Influence. A fantastic book. Uh, Business school, I went, my professor, John Hunt, he had fantastic, how do you manage people at work? Uh, I used to read a lot of Edward de Bono. In a lot of our meetings, we would run the six hats and so on. Simon Sinek, Start with Why.
Start with why, yeah.
Then Vern Harnish on how you scale up a business. Because, see, if you're talking to an entrepreneur and a businessman, you need to know management as well. See, I was lucky, I was also a manager. I was not only an investor because we were running a business by those principles of Jim Collins, actually. Fantastic books, Built to Last, Good to Great, and so on. And in finance, you'll know these typical names. So I started early with John Train, so all the money masters of our time and so on. Munger and Buffett was like, Bhagwan mil gaya abhi, we can understand something. Peter Lynch, Mark Faber, who taught me about market cycles. I currently read a lot of Mabusin. For every investor, they should read first the Psychology of Money of Morgan Housel. I think everyone needs it. Howard Marks, again, who's continuing this whole theory on cycles. Ray Dalio tries to, again, get that in your head. Ruchir Sharma is a friend, and I enjoy reading his work as well. Management books, I told you, Jim Collins. Michael Porter, I grew up on. Tools of Titans is a great book for someone who likes to read. Tim Ferriss. I told you about Vern Harnish. And when I was young, I read Geeta Piramal's books on India's industrialists, business maharajas, to just get our history and context. How Birlas or Tatas or Walchand and Godrej's, they all built it up. And for younger kids, I have really recommended this Vishal Khandelwal's book, The Sketchbook of Wisdom. Very interesting. I kind of put everything together in one page. So even if you're like, I've given it to maybe hundreds of kids who are in their teens, so they can learn on psychology and history and investing and management and everything. Very well compiled book.
How fascinating. I think we should have a
It's a
round of
great
applause
list.
just for that because we have a year's worth of reading.
Easily.
Absolutely.
You have
Yeah.
20 years of reading in this. Because not just reading, you must write your notes also alongside the book. So that when you go back and read it, it's like Gita, you read it every time when you turn, you find something new, some new nuance which you
So,
didn't get.
what you just said about,
Yeah.
I think, is the difference between
Yeah.
a great investor
No,
and the rest of us, right?
Lucky, right place, right time.
Okay. My final question to you, sir, would be if you had to pass on just one piece of market advice to your son, to your protege, what would that be?
Actually, the same. Well, first is you be a good person. Good things happen to good people, and be humble and share what you have. Because we've come to the world, I really believe, like you've come as a wire through which some electricity passes, and you have some special skill which Vinobaji calls your swadharma. So, if Sachin had played chess, he would have been lousy. If I had played cricket, I would have been lousy. So, you come for something which you're good at, then do that to the best of your ability and then share. Uh, Actually, that's the essence. You find that early in life, you're really blessed and you're really lucky. Like Michael Gladwell, he called it that 10,000 hours of practice will make you better at what you're good at. So a lot of people just rely on natural talent, and then like a bull market will make you feel there's no one smarter than me. But this whole study of market cycles, even astrologers I talk to, like Sade Sati, you can be the smartest guy, and if your Sade Sati is opposite, you'll be making losses. So it humbles you. There is a bigger universe out there, and we are a tiny fraction. So just keep perspective in life and be large-hearted.
That's such a
That's really,
beautiful
yeah,
thought. That's a
yeah.
beautiful thought. Thank you for sharing that.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.